shift. This is what it says now. The same thing. The committee anticipates that ongoing increases in the target range will be appropriate. So that stays in there. So that's the statement down with 50 basis point hike. Statement doesn't change too much. Then you go to the projections. The projections, the 23 dot has shifted from 460 to 5.1, and that's getting everybody's attention.
One meeting?
Widely anticipated. That's a shift from September, from the September projections to the fresh December projections. There's been a big cut to GDP growth. We've come down from 1.2% to 0.5. The likes of Neil Dutta pushing back against that. And a price action, well, it's shaping the market up as follows. On the equity market on the S&P, we're down by 0.4%. On the Nasdaq right now, we're down by about 5 or 0.6%. Lisa's shaking her head to some of the equity market action. In the bond market, yields are up by, let's say, 3 basis points on a 2-year to about 4.25 on a 10-year, Tom, to 3.52, up a couple of basis points. We're about 9 minutes away from Chairman Powell and his news conference.
And again, as I said earlier, I think more than anything in months and months in Fed meetings is this press conference is going to be absolutely fascinating. We just had a great chart up on radio. It looked great on radio as well. Karen, bring up the real GDP chart again. John, here's how the pros do it. You take 1.6% 2 years out on the edge of Andrew Bailey. What's he going to say tomorrow? 1.6%. And you add in some form of inflation of 2-ish, and I've got 4% nominal GDP in a heartbeat, which is not, that the animal spirit is there to keep this thing going.
Is that the path to a real recession, Tom?
No.
Those numbers.
That's my point.
Yeah, but 5% Fed funds, getting inflation down to 3. Get inflation down to 3 with 5% Fed funds. How much damage do we do?
Sarah House, a conversation this morning. What do you do with 3%? Then what? What's the then what?
Well, she said it's the last mile, and the last mile is difficult. Dan, can we speak to you about that? The last mile.
Yeah,
getting it down, never mind 7 to 5, the next push.
That's exactly it. The fact that they have 3.1% and continuing rate hikes tells you their commitment to not stop at 3. And that's really important because many people are starting to argue, well, why not let the Fed, 3% is not that much different from 2, 2 is somewhat arbitrary. Let's just stop at 3%. There's some very smart people that I admire out there arguing that. And the Fed has the perspective, and I'll never forget it, at Jackson Hole, Neil Kashkari said it, you can't do that in a raging inferno. And the issue is that the Fed can't move the target closer and say it's not going to go through that 3% threshold in an environment where their credibility is at stake and where they're worried that we could have a more corrosive bout of inflation that takes root in the underlying economy and that you can't eradicate the economy of the inflation we have. That's a very, very important message they're trying to send, is that they're not going to stop at 3%. With that 3.1% at the end of the year, how hard they believe that last mile is to go from 4 to 2 is in that forecast over years that they're talking about bringing it down.
Diane, let me just give you some Twitter feedback that I've gotten. Legit 0% chance that it's 5.1% at the end of next year. That was basically one comment, which is pretty much in line with what the market is saying, that we're not even getting up to there in May, which may be the peak of Fed funds. So, Diane, from a messaging standpoint, this Fed has already lost a lot of credibility, and there is an issue of, can you deal with the political backlash as the unemployment rate raises to the levels that you're talking about? How would you push back and say this Fed is serious when it has not been tested? And honestly, its past precedent has been exactly as Scott has said, which is they've gotten it wrong and the market's gotten it right.
Well, I think that's very important, and the Fed's credibility is at stake. That is absolutely where they're at, and I think they know that. This is the cardinal sin of a Federal Reserve, is to allow inflation to go and then also not be believed that they'll take it down the whole way. Now, they could be wrong, and I happen to think they're wrong too, but I understand where they're at, and this is part of the risk management and pushing back on the market, expecting them to cut sooner. They don't want to they are more than willing to start cutting rates if inflation comes down more rapidly. They have to send this message right now, and I think that's where they stand. They will be a political pinata. I have no doubt about Jay Powell's ability to handle the politics given what he's already been through.
And now your economic lesson of the day, folks, from the halls of Michigan Economics. We asked Diane Swank, what in God's name, Diane, does cumulative mean? I mean, explain. Is this like a word is Brainerd using this word to capture the calculus of 3 or 4 or 5 meetings of action? What's it mean?
Well, it means not only the fact that we've had cumulative rate hikes in the United States and over time, for instance, vehicle loan rates are lagging overall Fed funds rates. So over time, we'll see even more increases, 4 to 5% in vehicle cost of financing a vehicle and buying a vehicle. Just even what the Fed had done before this meeting is still baked in the pipeline. And so over time, that starts to accumulate and be larger. But also, it's the spillover effects. And I think that's the key that Brainerd brings to the table and the diversity within the Fed in terms of their perspective. She was there during the taper tantrum at Treasury in 2013. She knows that there's spillover effects from what's going to happen in the rest of the world, and that's where she's thinking of those cumulative effects.
Scott Minerd, I have 3 different messages in, and I'm going to do this 4 minutes before this press conference, and I'm going to go off topic. You are acclaimed as a student of what we're living in crypto and Bitcoin. Do you have confidence that system can move forward?
I do, Tom. A year ago, we were talking about crypto, and there were approximately 19,000 coins, to which my comment was, this is mostly crap, and there's going to be a washout. And just like the internet bubble, we will have survivors. And, the digitalization of currency is just in its infancy. And, how this evolves now is going to require, a regulatory framework to legitimize it. Yeah. And I think we will move forward, and I think this will, be transformative to the general economy.
Lisa would like to weigh in here, Mr. Minerd.
No, I don't want to weigh in on this per se, but there is a question of whether the whole FTX phenomenon really was born out of the easy money policies and whether there are a lot more shoes to drop in the financial stability aspect of this. As everyone talks soft landing and as we talk about disinflation, how much less of a chance is there of that outcome, which I know you've been talking a lot about?
In terms of the collapse?
Yeah, some sort of, more financial disruptions, shakeouts, that things going to zero that were overnight, that were worth tens of billions of dollars.
Sure. I mean, look, I think there's more to come, Lisa. And the reason is that, this is just like any number of periods where we've had easy money and a lot of speculation. And so the weakest players fall first. And so crypto was obviously something that was crazy. NFTs were, I never quite understood them.
I loved them. The one they did of me was just great, Scott. It worked out like a charm.
But you look at what happened with the Bank of England. We averted, I think, a global financial crisis there by their quick response. So, there's, I think, another shoe to drop, and I can't tell you where it is.
Thanks for the people emailing in on this, because I know it intrudes on a Fed meeting, but Minerd has, and frankly, Diane and all the rest have such a perspective here linking this in.
Part of the story. You've got discipline at 4-5% Fed funds that you certainly did not have at 0. Well, and hyper loose fiscal policy to go with it.
Is crypto and Bitcoin part of my zombie view for 2023? Mr. Minerd was alluding to that.
For when you publish the Outlook. Scott, always awesome to catch up, buddy. Scott Minerd there alongside the absolutely brilliant Diane Swong. I remember Diane, the last time she was on, and we talked about the projections. Looking back to September, I said to Diane, what do you think would be updated if we could have some projections in the November meeting? She said, big cut to GDP. Big cut to GDP.
She nailed it.
We've got a big cut to GDP in the projections today. I can tell you Kit Juice, just moments ago, out on Twitter from SocGen. The Fed is sending the market exactly the same message they sent 6 weeks ago. So they must be expecting exactly the same reaction, right? With a big question mark, Lisa, at the end, because I wonder what kind of price action we get coming out of this in 1 minute's time.
What kind of price action do they want? I mean, do they want to see the markets fall? If they do, well, what else do they have to do? Do they basically have to say, we want to sink you? I mean, honestly, they're basically saying we're going to raise rates beyond what any of you think, and we think that things need to really cool off much more, and no one seems to be paying much.
Scott brings up an incredibly important point that I failed in not bringing up, which is this is a Fed dealing with the new cost of money, and that hasn't been discussed enough. They're dealing with the risk-free rate comes back, all of these mergers we're seeing. Maybe it's the crypto stuff as well. But all of a sudden, John, we're where we were 12, 13, 14 years ago, and we're getting used to it again.
We're still assessing the damage from a really, really quick rate hiking cycle, 400 basis points plus. In what, Tom? 9 months? And there's still a massive debate right now as to how much damage this will actually cause in the first half of 23. I get the consensus, but you've got people pushing back against that view. Neil Dutter's one. That's just one. Max Kettner of HSBC is another.
And Ed Hyman today was brilliant with Paul Sweeney on this, and he said, look, the shock that we've had is tangible, and Ed Hyman's falling back to what he does, which he looks at the microdata of America. And he says, it's not that all that bad.
Chairman Powell, a little bit late, Tom. Just a few seconds.
I can't imagine. I don't think Morocco's going to get it done, Chairman.
Surely he's not
watching. You think he's in watching?
I don't think he's watching. Is he a football fan?
I don't know. He's 26 seconds late.
I am wondering if we get the same performance we got in November, or whether it's changed. I go back to those comments from Rich Clarida. Has the risk assessment changed on the outlook for Fed funds? Here's the chairman of the Federal Reserve, Jay Powell.
Good afternoon. Before I go into the details of today's meeting, I'd like to underscore for the American people that we understand the hardship that high inflation is causing and that we are strongly committed to bringing inflation back down to our 2% goal. Over the course of the year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by a 0.5 percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive policy stance for some time. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Although real GDP rose at a pace of 2.9% last quarter, it is roughly unchanged through the first 3 quarters of this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.5% this year and next, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in October, total PCE prices rose 6%. Excluding the volatile food and energy categories, core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has contributed to upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls 3.1% next year, 2.5% in 2024, and 2.1% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range, the policy restraint that we're putting in place to return inflation to 2%. We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a half percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We are taking forceful steps to moderate demand so that it comes into better alignment with supply. I will look forward to your questions.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You just talked about the importance of market conditions reflecting the policy restraint you put in place. Since the November meeting, the 10-year has declined by 60 basis points. Mortgage rates have come down. High-yield credit spreads have come in. The economy has accelerated, and the stock market's up 6%. Is this loosening of financial conditions a problem for the Fed in its effort and its fight against inflation? And if so, do you need to do something about that, and how would you do something about that? Thank you.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%. We think that financial conditions have tightened significantly in the past year, but our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves, and many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect, again, for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and we know. Obviously, if the inflation data come in, we know. Obviously, if the inflation data come in worse, that could move up, and it could move down if inflation data are softer.
Gina. Gina Smilik, New York Times. Thanks for taking our questions. The SEP, like you mentioned, suggests that the Fed will be making another 0.75 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments, 50 basis point increments, sort of how you see the speed playing out going forward. And then I wonder what you're looking at as you determine when to stop.
Yeah. As I've been saying, as we've gone through the course of this year, as we lifted off and got into the course of the year, and we saw how strong inflation was and how persistent, it was very important to move quickly. In fact, the pace with which we were moving was the most important thing. I think now that we're coming to the end of this year, we've raised 425 basis points this year, and we're into restrictive territory. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And then at a certain point, the question will become, how long do we remain restrictive? That will become the most important question. But I would say the most important question now is no longer the speed. So, and that applies to February as well. So I think we'll make the February decision based on the incoming data and inflation down into three sort of buckets. The first is goods inflation. And we see now, as we've been expecting really for a year and a half, that supply conditions would get better, and ultimately supply chains get fixed, and demand settles down a little bit and maybe goes back to services a little bit, and we start to see goods inflation coming down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up, actually, as rents expire and have to be renewed. They're going to be renewed into a market where rates are higher than they were when the original leases were signed. But we see that the new leases that the rate for new leases is coming down. So once we work our way through that backlog, that inflation will come down sometime next year. The third piece, which is something like 55% of the index, PCE and core inflation index, is non-housing related core services. And that's really a function of the labor market largely. It's the biggest cost by far in that sector is labor. And we do see a very, very strong labor market, one where we haven't seen much softening, where job growth is very high, where wages are very high, vacancies are quite elevated, and really there's an imbalance in the labor market between supply and demand. So that part of it, which is the biggest part, is likely to take a substantial period to get down. The goods inflation has turned pretty quickly now after. I'll tell you what the projection is. I don't think it would qualify as a recession, no, because you've got positive growth. The expectations in the SEP are basically, as you said, which is we've got growth at a modest level, which is to say about 0.5 percentage point. That's positive growth. It's slow growth. It's well below trend. It's not going to feel like a boom. It's going to feel like very slow growth, right? In that condition, labor market conditions are softening a bit. Unemployment does go up a bit. I would say that many analysts believe that the natural rate of unemployment is actually elevated at this moment. So it's not clear that those forecasts of inflation are really much above the natural rate of unemployment. We can never identify its location with great precision. But that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off. Other than the tech companies, which is a story unto itself, generally companies want to hold on to the workers they have because it's been very, very hard to hire. So, and you've got all these vacancies out there far in excess of the number of employed people. That doesn't sound like a labor market where a lot of people will need to be put out of work. So that there are channels through which the labor market can come back into balance with relatively modest increases in unemployment, we believe. None of that is guaranteed, but that is what their forecast reflects.
Thanks, Nick Timmeros of the Wall Street Journal. Chair Powell, I want to follow up on Gina's question. The decision to step down the pace of rate rises,
and that will allow us to feel our way and and get to that level, we think, and better balance the risks that we face. So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financial conditions.
With the CPI report, if it had come out last week, do you think it would have changed some of those forecasts in today's S&P?
No, absolutely not. No, as a just a matter of practice, the SEP reflects any data that comes out during the meeting, and participants know that they know that they can make changes to their SEP during the meeting, well in advance of the press conference, so that we're not running around. But that's not the case. It's never the case that the SEPs don't reflect an important piece of data that came in on the first day of the meeting.
Thanks. Rachel? Hi, Chair Powell. Rachel Siegel from The Washington Post. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the model suggests that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now? Thanks.
No, it's not about the strength of the labor market. The labor market is clearly very strong. It is more just that, by now, we've continually expected to make
versus vacancies trimming or changes to the labor force population rate.
So it's very hard to say. You can look at history, right? And history would say that in a situation like this, the declines in unemployment would be more meaningful, I think, than what you see written down there. But why do we think that is the case? So I'll give you a few reasons. First, just is that there's this huge overhang of vacancies, meaning that vacancies can come down a fair amount, and we're hearing from many companies that they don't want to lay people off, so that they'll keep people because it's been so hard. I mean, I think it feels like we have a structural labor shortage out there, where there are 4 million fewer people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce. So the fact that there's a strong labor market, means that companies will hold on to workers, and it means that it may take longer, but it also means that the costs in unemployment may be less. Again, that we're going to find out empirically. That's a reasonably possible outcome, and you do hear many labor economists believe that it is. So we'll see, though.
Thank you. Colby Smith with the Financial Times. How should we interpret the higher core inflation forecast for 2023 in the SEP? Does that not then suggest that the policy rate currently forecasted for next year should actually be higher than the 5.1 medium estimate penciled in?
Well, I think that's why one of the reasons it went up.
More pessimistic about what inflation is going to look like next year. And I was just wondering, given that we have seen some cooling in inflation, is that primarily because of wage growth, that you expect wage growth to be sort of a headwind?
No, we're going into next year with higher inflation than we had thought, right? So we're actually moving down to the level that we're moving down to next year is still a very large drop in inflation from where inflation is running now, well more than a 1% change in inflation. But remember that the jump-off point at the beginning of the year is higher. So, we're moving down still by a very large chunk. I don't think the policy's having any less effect. It's just starting from a higher level at the end of 2022. So we're getting down. I believe the median is 3.5%. That's a pretty significant drop in inflation. And where's it coming from? It's coming from the goods sector, clearly. By the middle of next year, we should begin to see lower inflation from the housing services sector, And then, the big question is how much will you see from the largest, the 55% of the index, which is the non-housing services sector. And, that's where you need to see, we believe you need to see a better balancing of supply and demand in the labor market so that you have, it's not that we don't want wage increases. We want strong wage increases. We just want them to be at a level that's consistent with 2% inflation. Right now, if you factor in productivity estimates, they're running, well above what would be consistent with 2% inflation. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
Steve Matthews with Bloomberg. Let me ask you about China. In the last few weeks, China has abandoned its COVID policy and been reopening pretty strongly. I'm wondering if you see that as disinflationary because you're seeing supply chains improve, or inflationary because it obviously brings a lot more demand globally and improves the global outlook for growth and for commodities prices.
And so you're right. Those two things will offset each other. Weaker output in China will push down on commodity prices, but it could interfere with supply chains ultimately, and that could push inflation up in the West. It's very hard to say, how those two will offset each other, and it doesn't seem likely actually that the overall net effect would be material on us. But to your point, China faces a very challenging situation in reopening. And we've seen waves of COVID all around the world can interfere with economic activity. China, a very critical manufacturing place for manufacturing and exporting. Their supply chain is very important. China faces a reopening. They've backed away from their COVID restriction policies. There could be very significant welcome reduction in the monthly pace of price increases. As I mentioned in my opening statement, it will take substantially more evidence to give confidence that inflation is on a sustained downward path. So the way we think about this is this. This report is very much in line with what we've been expecting and hoping for. And what it does is it provides greater confidence in our forecast of declining inflation. As I mentioned, we've been forecasting significant declines in overall inflation and core inflation in the coming year, and this is the kind of reading that it will take to support that. So really this gives us greater confidence in our forecast rather than at this point changing our forecast. In terms of the pieces, we have been expecting goods inflation to come down as supply chain pressures eased. That's happening now. Housing services, as I mentioned, there is good news in the pipeline. As long as new housing leases show declining inflation, that will show up in the measure around the middle of next year, so that should help. And the big piece, again, is core services ex housing, which is very important, and we have a ways to go there. You do see some beginning signs there, but ultimately that's that more than half, as I mentioned, of PCE core index, and it's very fundamentally about the labor market and wages. If you look at wages, look at the average hourly earnings number we got with the last payrolls report. You don't really see much progress in terms of our average hourly earnings coming down. Now, there may be composition effects and other
on inflation, whether the recent disinflation we're seeing is transitory or not, and how this affects the idea of a soft landing if you're projecting just 0.5% growth for this year.
So, if I think I got your question. So, one thing is to say is I think our policies in getting into a pretty good place now. We're restrictive, and I think we're getting close to that level of sufficient. We think sufficiently restrictive. We laid out today what our best estimates are to get there, it boils down to how long do we think this process is going to take. And of course, we welcome these better inflation reports for the last 2 months. They're very welcome, but I think we're realistic about the broader project. So that's all. That's the point I would make. It's we see goods prices coming down. We understand what will happen with housing services, but the big story will really be the rest of it, and there's not much progress there, and that's going to take some time. I think my view and my colleagues' view is that this will take some time. We'll have to hold policy at a restrictive level for a sustained period, so that two good monthly reports are very welcome. Of course, they're very welcome, but I think we need to be honest with ourselves that there's inflation. 12-month core inflation is 6% CPI. That's 3 times our 2% target. Now, it's good to see progress, but let's just understand we have a long ways to go. Less of an increase in unemployment than would be expected given the historical record.
Hi, Chairman Powell. Brian Chung, NBC News. You warned Americans of pain earlier this year as the Fed hikes rates, but with the Fed now expected to raise rates higher than you thought when you first said that, just wondering where we are in that pain. How would you describe that to Americans if the projections on unemployment find themselves? That would be 1.6 million Americans out of jobs.
So the largest amount of pain, the worst pain, would come from a failure to raise rates high enough and from us allowing inflation to become entrenched in the economy so that the ultimate cost of getting it out of the economy would be very high in terms of unemployment, meaning very high unemployment for extended periods of time, the kind of thing that had to happen when inflation really got out of control and the Fed didn't respond aggressively enough or soon enough in a prior episode, 50 years ago. So that's really the worst pain would be if we failed to act. What we're doing now is, it's raising interest rates for people. And so people are paying higher rates on mortgages and that kind of thing. There will be some softening in labor market conditions. And I wish there were a completely painless way to restore price stability. There isn't. And this is the best we can do. I do think, though, that and markets are pretty confident, it seems to me, that we will get inflation under control, and I believe we will. We're certainly highly committed to do that. Under any circumstances, we're gonna keep our inflation target at 2%, and we're going to use our tools to get inflation back to 2%.
Nicole. Thank you, Chairman Powell. Nicole Goodkind, CNN Business. As you monitor wage growth and unemployment data, I wonder if you're paying close attention to a sector or even income level. Like, how do you factor potential exacerbations of inequality into your risk calculations, especially given the K-shaped recovery of 2020?
So I would go back to the labor market that we had in 2018, 19, 20. So what that looked like was wage increases for the people at the lowest end of the income spectrum were the largest. The gaps between racial groups and gender groups were at their smallest in recorded history. All of that because of a tight labor market, which had inflation running, just a tick below 2%, and the economy growing right at its potential. So that seems like something that would be really good for the economy and for the country if we could get back to that. And so that's what all of us want to do. We want to get back to a long expansion where the labor market can remain strong over an extended period of time. That's a really good thing for workers in the economy, and we'd love to get back to that. That's what our goal is. There's in the near term groups and that sort of thing. We do. We keep our eye on that.
Hi, Nancy Marshall-Genzer with Marketplace. What would you do if the economy slows so much that we enter a recession before we see strong, consistent signs that inflation is slowing? In other words, stagflation.
So I don't want to get into too many hypotheticals, but it's hard to deal with hypotheticals. So let me just say that we have to use our tools to support maximum employment and price stability. I've made it clear that right now the labor market's very, very strong. You're at near a 50-year low, where you're at or above maximum employment, in 50-year low in unemployment. Vacancies are very high. Nominal wages are very high. So the labor market is very, very strong. Where we're missing is on the inflation side. and we're missing by a lot on the inflation side. So that means we need to really focus on getting inflation under control, and that's what we'll do. I think as the economy heals, the two goals come more into play. But right now, clearly the focus has to be on getting inflation down.
Thank you, Chairman Powell. Greg Robb from Market Watch. You spoke a little bit ago. You said that the U.S. it looks like we have a structural labor shortage in the economy. Could you expand on that? Talk a little bit more about that. And really, are you talking?
It's 3.5 million people, at least, smaller than it should have been, based on pre-pandemic. Just assume population and reasonable growth and aging of the population. Our labor force should be 3.5 million. More than it is, and that it can. There are lots of easy ways to get to bigger numbers than that if you go back a few more years. So why is that? Part of it is just accelerated retirements. People dropped out and aren't coming back at a higher rate than expected. Part of it is that we lost 500,000 people who would have been close to 500,000 who would have been working who died from COVID. And part of it is that migration has been lower. We don't prescribe, it's not our job to prescribe things, but I think if you ask businesses, pretty much everybody you talk to says there aren't enough people. We need more people. So I tried to identify that in a speech I gave a month ago, but I stopped short of telling Congress what to do because, they gave us a job and we need to, do that job.
Thanks. Jennifer?
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You say you expect growth of just 0.5% next year. Given that you've said the process of raising rates and getting inflation back under control will be painful, have you had discussions within the committee and addressed how long and or how deep of a recession you would be willing to accept?
No. I mean, what we do is we make our forecasts and we publish them quarterly, and practice that we've carried on for many decades. But no, we don't. We haven't asked ourselves that question.
We'll go to Jean for the last question.
Hi, Jean Young with Market News. I wanted to ask about the SEP again. If you're reaching peak rates around 5% in the first half of next year, and inflation starts to decline materially, that would seem to make the real rate gradually more restrictive. Is that something that's built into the projections and into models? Is that something you would want to see?
So we do know that, of course. That's something that we know and we'd see. But as I mentioned, we wouldn't. I wouldn't see the committee cutting rates until we're confident that inflation is moving down in a sustained way. That would be my test. I don't see us as having a really clear and precise understanding of what the neutral rate is and what real rates are, so that it would mechanically happen like that. It'll be a test of for cutting rates. I think in the event it'll be a question of, do we actually feel confident that inflation is coming down in a sustained way? Thank you very much.
That wraps up the news conference with Chairman Powell. That wraps up 2022 for the Federal Reserve. Live from New York City this afternoon. Good afternoon to you. Your equity market on a round trip, basically unchanged on the S&P 500. A couple of things to say here on the assessment of inflation. The response to the latest CPI report, in line with what we were expecting and hoping for, it would take substantially more evidence. The Fed chair went on to say, overwhelmingly participants believe inflation risks remain to the upside.
The grizzled people in the press conference, including the ancient McKee, and he stopped the chairman. This is serious stuff. It's all, he's reading off the desk. It's all rote, boring. And he asked that question, and Powell stumbled, and then boom, we went up 300 Dow points.
Stocks picked up. They're down a little bit right now by 1% on the S&P, just to whip through some of the price action for you. Looking at the bond market, the 2-year basically unchanged. Your 2-year now at 422, your 10-year coming in a couple of basis points to 348. But we've got to save the most bizarre moment in that news conference for Bramo's take. Bramo asked about the 2% inflation target. The first response was basically no thanks. We don't want to take a look at that. And then for some reason he added on maybe a longer-term project.
You and I both looked at each other like, no, that's not what you want to be saying. I mean, honestly, first of all, nobody's really taking that as gospel, because there's no way that they would even signal that that would be something that they would take on. But this is a sort of his fallback to the nuance of an economist, of a market watcher that is not welcome by this market. I just want to say, the Fed's words basically said, we're hawkish, we've got more work to do, we're going to raise rates. The way that the market took it was, oh, so that means that in February it's going to be a step down to 25 basis points, you're almost there, and you'll be cutting rates by the end of next year. That's what the market is saying.
That's the distinction, the spread between what this Fed is trying to signal and what this market is hearing. You're 2 years at 422, and Tom, the Fed is telling the market, look at the S&P. Look at the S&P again. We've got a 5 handle
it's like a broken record.
Pay attention. No rate cuts next year. Look at that 5 handle.
You and I were waiting for a risk assessment, and it really never came. It somewhat came.
Just a little bit, but not much. I agree.
What we're going to do now, and this is the great privilege of all the work we do each and every day, is we spent a lot of time below 2%. When Powell says 2%, how do you frame that with the history of below 2%?
Right now, we have a bit of an asymmetry in policy. When we're below 2%, we want to go back above it to offset misses to the downside to keep inflation expectations well anchored at 2%. But when we're above it, we just want to go back down to 2%. So there is an asymmetry in terms of how policy is actually being executed. So the Fed hasn't really talked about this explicitly, but that's how they're talking and how they're behaving.
The partial differentials between goods inflation coming down rapidly with a nice oil help, we all get that, and the stickiness of services. Do you have any optimism that service inflation can actually come down in a service sector America?
Well, it's all about the labor market. Chair Powell made it very clear that the way to make progress on services inflation is to have more slack in the labor market, so wages are more consistent with 2% inflation. Right now, wages are rising 5 to 6%, depending on what index you look at. That's way too high to be consistent with 2% inflation. This is why it's going to take the Fed a while to achieve what they want to achieve. They have to slow the economy down sufficiently to generate enough slack in the labor market so wage trends come down to be consistent with 2% inflation. I thought it was interesting that Powell basically implied that the fourth quarter forecast, year-end forecast for interest rates was the peak for interest rates. He basically said that we're going to that level and we're going to stay there throughout 2023. I also thought the other thing that was very striking was the hawkish remarks and hawkish projections. I guess, the way you can square the circle is the markets think the economy is going to evolve in a different way than the Fed does.
Or the market's just looking at this and thinking this is what the Fed wants to signal now because they want to tighten financial conditions. But ultimately, Bill, we don't think it's achievable, and we don't think they even believe in the dot plot. Bill, what would you say back to that?
I don't think the Fed is saying this just for the sake of making their job easier. I think this is what they really believe. I mean, it's been pretty consistent framing of over the last year. Each meeting, the Fed's going to go further. The unemployment rate's going to go higher. The terminal interest rate's higher. The Fed has been very disappointed by how slow they've gotten a hold of things. And obviously, to the extent that they've been late in tightening monetary policy, that's why they've had to go farther than what people have anticipated. So look, my view is, the markets can believe whatever they think. But at the end of the day, the Fed holds the whip hand. They determine the path of short-term interest rates.
True.
So the more the market ignores the Fed, all that's going to do is force the Fed to keep rates higher for longer. So the Fed's going to win that battle.
Bill, the Fed may win, but the messaging is getting increasingly muddled. I was really struck, and I know that John and Tom were as well, by the answer to would you ever consider moving away from a 2% inflation target? And at first, Fed Chair Jay Powell said, absolutely not. And then he said, whether it's a longer-term project, who knows? We both were thinking, does he really want to be saying that? I mean, at what point is he signaling perhaps a less restrictive tone than what he wants there? Do you think they went far enough with their projections of a slowdown?
Well, they're certainly moving in the right direction. I mean, if you go back to look at the 4 SEPs that we've had this year, March was a total fantasy. June was just on the edge of plausibility. September was a little bit better. And now we're getting at something that I think is, possible, but not likely. I think this is a pretty benign forecast in terms of how you get inflation back down to 2%. It could work out this way, but it's probably not the midpoint of the distribution.
Bill, we're going to pick up on those doubts in just a moment. I want to bring in Mike McKee, who's ran back out of the news conference to catch up with us. Mike McKee, we talked about your comment to Fed Chair Jay Powell and his response to you that we're getting closer to a sufficiently restrictive rates level. Mike, what was your big takeaway from that one?
Well, he sort of took both sides of that issue, saying earlier in the news conference that there are still quite a ways from it being restrictive, and so they have to do more. So that was a little bit confusing. I think what Powell is trying to do is jawbone the markets to a certain extent. It's not that the Fed is way behind, but he did sound like he thinks they're behind on the question of inflation, that inflation is proving stickier and more difficult to bring down, or at least that's their forecast, than they had thought in September. Now, maybe it's as Bill said, they weren't being realistic before, and they're being realistic now. But it does seem that it puts them in a position of having to be more hawkish than people anticipate because they're not getting the job done.
Mike, one question here before you get back to Bill Dudley. I think it is just so important. There were numerous questions about the comfort of going back to a Greenspan-ian.
But we'll have to wait and see what they think come February 1st.
Bill Dudley, let's go philosophical here. I'd love to have you write a long essay on this for Bloomberg Opinion as you choose. The y-axis is going to give us level. And the basic idea, and you have led the way on this, is we've got to get the level up for a number of select reasons, including defeating high inflation. On the x-axis is the time function. Can a lower for longer level of Fed effort substitute for going up the y-axis to whatever higher Bill Dudley level? Can the x-axis help us with the level of the y-axis?
Well, I think the Fed's approach is that they don't want to raise rates so high that they generate a really deep downturn. And the way to avoid doing that is move to restrictive and then hold it there so you have time to assess the consequences of your actions. So, clearly they're being careful. I mean, this approach is a careful approach designed to slow the economy down, perhaps have a mild recession, but not crush the economy. So they're essentially trying for a soft landing with a good chance that they don't succeed. But that's certainly a better philosophy than going full Paul Volcker, where you just raise rates until the economy collapses.
Bill, are you concerned about the consensus, the continual consensus on the Fed?
Well, I think the consensus on the Fed will be harder to maintain once the unemployment rate really starts moving up in a significant way. The Fed does have
some of your belief in the stickiness.
Not really, for two reasons. As Chair Powell has made it clear, you need to have progress on services, ex-housing, and that requires more slack in the labor market. The Fed hasn't made any progress on services, inflation, ex-housing, and they're not likely to until they actually see much more slack in the labor market. So it's really the lack of slack in the labor market, the fact that the last payroll employment report was still very sturdy, 261,000 increase in payrolls, means that the Federal Reserve still has a lot of work to do on that front.
Hey, Bill, wonderful to catch up. Just a fantastic tradition to catch up with you on Fed Decision Day. Bill Dudley there, formerly of the New York Fed, now of Bloomberg Opinion and so much more. Got this message just moments ago from Steve Cheverone of Federated Hermes. Lisa, he said this: he can't help himself. He's right there approaching the finish line of delivering a clear and consistent message, and then poof, he goes one sentence too long. Now, I know it's fashionable to beat up on the Federal Reserve, but you did get that sense with Chairman Powell a few times, Lisa, in that news conference.
Yeah, that he really just said a little bit too much, opening the door to dovishness. And this is a market that wants to rip, right? I mean, that's basically what we've felt for the past couple of weeks. And it found a reason to rip when he said that they're getting close to where the end rate could potentially be.
Well, it's fading right now. We're down about 1% on the S&P 500, 30 minutes away from the close. Yields just a little bit higher by 2 basis points on a 2-year to 4.24, on a 10-year down by a basis point to 3.49. If you're just tuning in on TV and radio, this is a Fed special with Tom Keene, Lisa Bramett and Jonathan Ferro. Good afternoon to you all. A little bit earlier this afternoon, a 50 basis point hike from the Federal Reserve, a step down. The statement largely unchanged. The signal in the projections, perhaps just a median dot in 23 with a 5 handle. So now we're talking about a 5 handle on Fed.
For the data, you and I were talking about it when he was in conference. January 12th is before the February meeting.
That's the CPI print, right?
February 1. Yeah, it's a CPI print. And, 3 times a chart, you get a hat trick, a trend towards disinflation. It's a different dialogue. What if it goes up? Then what?
Hey, true. Bob Michael of JP Morgan asked that question of Mike McKee on the open a little bit earlier on Bloomberg TV. He basically said, what about if the disinflation of the last few months is transitory, if you can get your head around the framing of that question? But ultimately, he's got a point.
Especially given, and I know that commodities, you strip it out, you take a look at core, but if you take a look at what gasoline, if you take a look at what crude levels have done, if that reverses, how much does that change? Does that shift some of the narrative that we've seen really take hold?
Ben Emmons writes 6 paragraphs. He underlines McKee's question. That's the impact that Mike McKee had.
Mike McKee's just absolutely
he's just
brilliant.
crushing it.
Can I say that news conference was a bit snoozy? Didn't you think?
Yeah, it was snoozy.
I don't know if I've got a bias about getting back to the football and finishing the year, but
everybody was.
I got just a little bit,
I got so many messages, basically just saying France just got a goal. France just got a goal.
No, but
that's what you guys
seriously, Leisman opened strong, and then it was a snooze fest pretty much, and then McKee, boom, and that's.
I said to the team in the control room, get ready, because I think this is going to wrap up early. But I don't know if it's just out, my bias because I want to get away, but that was a little bit snoozy.
You don't like
that? That could be your bias.
I love you.
Well. Can we go to someone who cares? Let's go to someone who cares right now. Jeffrey Rosenberg has joined the pantheon of Bloomberg surveillance people that change the moment, capture the moment. He is the first person we have heard of our conversation with Wall Street who talked
where you could see that not going down, that could go up while core inflation goes down. And what Powell's underlying here is that the real uncertain dynamic with regards to the inflation outlook is the wage dynamic, and he's kind of cautioning that they're not quite so sure that they've got a handle on the wage dynamic, despite the really good news that they're seeing in terms of the broader inflation picture. So I think the jury's still out on that risk, and outside of housing, you haven't really seen this economy slow.
Exactly.
So there's a lack of interest rate sensitivity, and it's showing up in income, it's showing up in wages, it's showing up in the broader economy outside of tech layoffs, which is really liquidity and not the broader economy, and housing. So there's a real risk there that we are already there.
Jeff, that's right where I wanted to go. And when the headlines came out, my first comment was on GDP, which I know is away from your remit at BlackRock, but still there is a belief here of a slowing economy. We have a select group of people that are saying just what you said. Maybe except housing, things are pretty good. Did they underestimate the American economic resilience?
Yeah, or the flip side is there is an overestimation to the interest rate sensitivity of the economy. The way to look at this from the flip side is look at how much in the post-GFC environment we needed to stimulate the economy in terms of interest rate cuts, effective interest rate cuts through a massive increase in QE, and what type of inflation is not coming down according to forecasts under that scenario.
Which is the reason why Bill Dudley, the former New York Fed president, just said when the market just ignores the Fed, they have to do more. So they have to raise rates even further. Given that prospect, Jeff, would you lean against this rally hard? Would you basically lean against this desire to rip, which seems to be evident in all risk assets over the past few weeks?
Yeah, it's been going on for some time, and we've had a kind of a back and forth and a little bit of debate of, whether we've seen the bottom in equity markets. I think the jury is still out, and I think a more cautious stance is still warranted, mainly, again, because the proof is in the pudding of the Fed's restrictive policy. It's in wage inflation, and you really are running still at a 5% level. Yeah, there's long and variable lags there, but I think until you start to see definitive definitive evidence that you've had success in reining in the wage inflation piece, you want to take a more balanced and cautious stance.
Off the Bloomberg screen, John, and this is critical, and let's not doubt 10,000, but I'm sorry. You measure this on standard deviation. The Bloomberg Financial Conditions Index just ticked up negative 0.493, under half a standard deviation of restriction. It's going completely opposite of the chairman's desire.
One way that he managed financial conditions in the last couple of meetings was by emphasizing the risk management approach to all of this, Tom, and it's something we spent a long time talking about, Jeff, and I was surprised there wasn't a bigger focal point in the news conference. This chairman has almost gone out of his way, particularly in the last news conference, to tell us.
And so I think we move away from the risk management approach, because the risk management approach gets us to 5% next year. Keeping at 5% relative to market expectations for them to quickly turn and cut is the reiteration we did hear today, and I think we'll continue to hear about not heeding the lessons of history of taking back policy tightening too early.
Well, Jeff, isn't that the complicated point here, and probably a great place to end this interview? This is going to be a tense point for this market versus this Fed, I think, for the next 12 months, Jeff, because they're saying they're not in the business of forward guidance. At the same time, they're saying, look at this tool we've got over here. This is our best case, our best guess on where we think rates are going to end the year next year. It's got a 5 handle. Look at it. Big 5 handle. And this market's saying, yeah, whatever. I don't think it's achievable. We think we get cuts next year. Jeff, how does that resolve itself? What's the tool the Fed has got to really drill that home? Because I don't think, Bill Dudley said it a bit earlier, well, at the end of the day, the Fed's going to win because they've got the tools. They control short-term interest rates. But Jeff, in the near term, they can't control financial conditions in a sufficient way because this market does not believe the extent of tightening that they're going to deliver.
Well, it doesn't believe that, but at the same time, it doesn't believe that because it also believes that they are going to have that success with regards to inflation. Look at those consensus forecasts for inflation, steadily declining over the next 2 years to the 2 to 2.5% forecast. So there is a belief that they're going to have success and really too much success. And so, the thing I would look at to answer your question is look at the dispersion in the 2024 dots.
Yeah.
That's the kind of environment that we're going into. So while today, it's pretty consensus around a 5%, a few.
Median 24, 4.1. If you go to the right side of the table, you'll get the range, and this is what Jeff is talking. Median 24, 4.1. If you go to the right side of the table, you'll get the range, and this is what Jeff is talking about. The range for 23 is 4.9 to 5.6. So really, really tightly bunched, hawkish projection from most of the people on the committee. And a bulk of that, the overwhelming majority, is north of 5. Tom, when you get the spread, it's 24. When you look at the breakdown of the range of estimates for Fed funds in 24, for whatever that's worth, but this is the point Jeff's making, it's 3.1 to 5.6. Tom, if there's any dissent out there right now, the dispersion is in those projections for 24.
I totally agree with the dispersion analysis, but I don't think it's dissent. I think it's absolutely unique.
I'm not saying it's dissent by definition. You know what I'm trying to say.
Yeah, I know what you're saying, but coming out of a pandemic,
it's grumpy.
We are in totally unknown. We're in unknown territory, and we're still there. And frankly, I think they're a great job of managing it. To my point with Dudley, what I'm really looking at here is a Fed setting us up for interest rates higher, longer, even if they don't get out to Bullard or Anna, for that matter, Anna Wong territory.
That's the point of tension going into 23.
Yeah, to me, that's the
Without
tension. I've said this for months. It's an x-axis analysis, not a y-axis analysis.
Another show still to come. Counting it down to the close, I'm pleased to say that joining us now is Romain Bostic. Hey, Romain.
Hey, John. Yeah, of course, Will Powell has spoken. The dot plots has spoken. Really, the question right now is whether the market is going to believe him, particularly when it comes to some of those economic projections, as well as that terminal rate here as we count down to the closing bells. A lot of great guests coming up.
You take a look at the Fed funds projections. They are currently projecting a peak rate of below 4.9%, despite the fact that that was the lowest estimate in all of the range of projections for the end of next year. And this was for May of next year. Just a wholesale repudiation of what the Fed is saying. So who's right, and how can the Fed regain credibility?
Final word. Mbappe's getting battered, isn't he? In that game.
He's getting slammed
kicked around.
To the point where he's getting kicked around, where I wonder, assuming that France wins, how he does against Argentina. Saturday, I believe.
Assuming it finishes 2-0 and they progress.
Yeah, but we're doing
it's
what
important stuff,
we,
Bramo.
yeah, can we just say thank you to all of you? I mean this.
Why.
Thank you to
Like, oh, it's a
all of
snooze
you
fest.
who did the adult thing and stayed with our conversation while
yeah.
you watched this great
You think anyone's left?
Yeah, everyone's gone. They're watching a
That's
bop
cute,
it.
TK. I like that. That was highly aspirational. From New York City on TV and radio. We'll see you tomorrow morning. This was the Fed Special. This is Bloomberg TV.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Bloomberg World Headquarters, I'm Charlie Pellet. Powell speaks, Wall Street listens, stocks move lower. Right now we do have the 10-year yielding 3.46%, the 2-year 4.21%, the Dow, the S&P, NASDAQ all in the red, with the S&P now down 28 points, drop there of 0.7%. The Dow is down 185 right now, down 0.5% off session lows. NASDAQ is down 90. Outlook from Diane Swunk, chief economist. Chief economist at KPMG.
This is a mild recession that they're forecasting. And, the question is it more abrupt up front and do we get rid of inflation more rapidly? Or is it something that's more prolonged and they slowly grind inflation out of the economy? Either way, those are still two tough scenarios, neither one of which the financial markets have fully absorbed.
And again, the 10-year now yielding 3.45%, the 2-year 4.21%. Spot gold down 0.1%, 18.08 the ounce. West Texas Intermediate crude up 2.7%, 77.41 a barrel. Recapping stocks now lower, 13 minutes to go ahead of the closing bell. S&P down 0.6%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just about 11 minutes left in today's trading session, wrapping up our simulcast coverage of the Fed's latest decision, the last Fed decision of 2022. As expected, 50 basis points after 4 consecutive hikes of 75 basis points. Markets gyrating, moving.
Lines look like, inflation is peaked and we don't, it's much less of a concern. And when you started looking at the numbers and you saw the consumer inflation rate actually was, flat. And if you take out certain items, it was even up. And this is the same way. I mean, Fed Chair Powell was talking about, being more in restrictive territory, and even mentioned 25 basis points on the table for February. So that was positive, for stocks. Yet there are also comments on that inflation is going to be sticky and especially on the wage front and like on the consumer inflation side that that if they're going to err, they're going to err on the side of caution. So I think you had a little parts for both the bulls and the bears. That's why you have that kind of volatility.
I know. I feel like net. It's interesting. He said we're getting close to that level we think of sufficiently restrictive, which kind of says to me, Alan, that, all right, maybe we're getting there to at least the Fed stopping in terms of raising rates. But he also said the Fed still has, quote, ways to go, which what does that mean? Higher for longer? Like, how do we read between the lines when I feel like you said, you got it's a little bit of a Fed J. Powell buffet.
Yeah, it is. It definitely is, Carol. I think the best. I think the best thing is just to you're getting closer to the end error on the side of caution and inflation. And I don't think 2023 is going to be. I don't think 2023 is going to be difficult as far as for passive investing. But if you're selective and disciplined, it really hasn't been that bad a year. You've had some income opportunities with energy, and now I think the interesting thing, we've always talked interest and dividends and high quality. I think with some of these good quality companies that don't pay dividends that have just been totally slammed 70-80%. I think there's some good opportunities there that investors, if there's tax loss selling or further pressure, can if they have a 2-3 year time frame can really make a lot of money. So it's contrary to what most people are saying, but again, I think that's where investors will make the most money in 2023, and the risk reward isn't that bad because some of those companies have been slammed so much and have opportunity. Not all of them, so don't just buy across the board because they're down 80%. So.
What did you make of the update of the summary of economic projections that showed a revision of the terminal rate to 5.1% reached last year? Is that still optimistic in your head, given that we're still seeing inflation at generational highs right now?
Yeah, but it's reachable. I mean, if you look, Tim, at a quarter point in February, then we're very close. So I think it's a situation where that is one of the areas where investors can take a little comfort and might be feeling that we're close to the end. But I really think as we get into 2023 that
not real, considering maybe that the global macroeconomic environment has changed?
Yeah, I think if he's stubborn on that, that's where you get that higher for longer and a real difficult environment where you could even not be talking a slight recession but something worse. And I think that's in the back of the minds of investors. So that I think will always and we started the year 2022 saying there's a ceiling on valuations and to be cautious and that's why even 2023 with the market down so much, I still think there's a ceiling on valuations because of that, Carol.
Yeah.
What's that ceiling?
The trading range that you've seen, of late, like we were testing, and it looked like if the market, held their pre-market gains yesterday, we could finally be breaking through, some 200-day moving averages and look, more positive on the longer term front. And every time we get close to those type of areas, the market, fades back. And it's one reason or another, whether it's Fed Chair Powell or as far as something going on geopolitically. But I think, that says a lot, just even from a technical standpoint.
All right, so well, we're halfway through December. We're getting ready to wrap up the new year. It's funny, we've been talking with our Bloomberg Business Week team for some of our year-end wrap-up shows and how many of the stories that are going to stay with us, whether it's business stories, individuals, and Elon Musk, a Twitter.
But I think, those are the opportunities, just like, Deere and Goldman Sachs and Merck were the good opportunities, 4 or 5 months ago. So,
yeah.
So I think that's going to be the most important thing for your listeners,
okay.
Rather than the macro.
Well, Alan, have a good new year and happy holidays. Alan Lance over at lanceglobal.com joining us on the phone from Toledo, Ohio. Folks, we're going to get ready to join our TV colleagues, talk about the markets, count you down to the close on this Fed Wednesday. This is Bloomberg.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick, Scarlett Fu here, counting you down to the closing bell. Here to help take us beyond the bell. It's a global simulcast with Carol Massar and Tim Stenovic. We welcome our audiences across Bloomberg Television, Radio, Quick Take, as well as on YouTube. Carol, make no doubt about it. This is still a hawkish Fed.
Yeah, no doubt about it, right? And this is one of those meetings where actually the statement, the decision, and the press conference all kind of said the same message. There's no doubt about it. The Fed, Tim, saying that they're going to continue raising rates. It's all about getting inflation back to that 2% target.
I mean, in that sense, I'm a little surprised that we're not seeing more of a reaction from at least equities right now, given that it's so clear the Fed is going to do what it takes to get back to that 2% level. And you can forget, Scarlett, about changing the definition of, inflation for the Federal Reserve. Reserve, Jay Powell, shrugging that off pretty quickly, saying, no, we're going to stay at that 2% goal.
Yeah, 2% is it, although they have moved it around.
50, maybe another 75 basis points of rate hikes into 2023. Whether we get that all in one shot or whether maybe he downshifts to 25, 25, 25, that remains to be seen. Anyway, here's the market reaction here. We had a pretty decent rally on our hands, a third day of gains heading into this meeting. That's all been erased here since the press release drop and, of course, the statement and Q&A out of Jay Powell himself. The Dow Jones Industrial Average down by about 0.4%. S&P 500 down by about 0.6%. The NASDAQ Composite down by about 0.8%. And the Russell 2000 going to finish the day lower by roughly 6 to 0.7%.
Yeah, and Romaine, most names in the S&P 500 lower. We're going to get into those industry groups in just a moment, but I always like to look at what's going on in the bank sector. The KBW Bank Index finishing just off its lows, down about 1.7%, Scarlett.
Yep, and you see it here reflected in the 24 industry groups in the S&P 500. Banks are lower by 1.2%. Diversified financials down by 1.5%. Most of the decliners here are interest rate sensitive groups. Financials certainly there. Real estate investment trusts also there. On the flip side, when you look at the gainers, very defensive, household and personal products, pharma, and transportation remain. I know this is something we've been talking about, and we're definitely going to get back to it, but transportation remains relatively firm, up 0.3%.
Yeah, always a great indicator of the economy, so I agree. I'd love to keep a watch on that. One thing I feel like that has definitely been under some upside momentum, at least over the last couple of days. Moderna, continuing to be top of the NASDAQ 100 and the S&P 500. It's roughly, guys, up about 25 or 30% in the past 2 days if you go from its peak, if you will. Yesterday's move was the biggest in about 2.5 years. We know, right? We've seen it active in the options market today, $3 and change there.
And I just want to add one to your board, too, a smaller cap company, but Rent the Runway. I was just kind of keeping my eyes on this. Finished the day higher by about 22%. And since they reported earnings, I think it was last week here, basically the stock has almost tripled.
Wow.
13% still shorted. I always wonder how much of it is short covering, right?
I think a lot of it is.
Right? When there's been such a negative tone, then all of a sudden it's on a tear. All right, Tim, what do you got?
All right, I got stocks that are on the opposite of a tear. I think we can pretty much classify Tesla as one of those. Shares finishing the day down by another 2.6% today, down 7 of the last 8 days. This time it's because Goldman Sachs slashed its price target on a Tesla by almost a quarter. An analyst, Mark Delaney, cutting the target from 305 to 235. Delaney said that his reduced estimates are consistent with the added incentives and price reductions for certain Tesla vehicles this quarter, reduced wait times, and soft macro conditions.
Apple shares point out to officially closing below that $500 billion market cap level today.
Yeah, lowest since November of 2020. Thanks for that, Romaine. And then Apple finishing it down by 1.5%. We did see major tech and internet stocks move lower after that more hawkish tone from Jay Powell and the Federal Reserve. And then Charter Communications having its worst day ever. It announced a large-scale broadband expansion plan. It's going to cost far more than analysts anticipated, finishing it down by 16.4%. It's a 3-year network spending budget starting with $10.7 billion next year, $1 billion more than analysts expected. That is some serious CapEx being laid out there.
Serious CapEx. I thought it was interesting how it dragged down some of the other players in that space there. We do want to go back, of course, to, I guess, the debt markets. Actually, the reaction that we saw in the debt markets, whatever the phrase you used a couple days ago.
Or semi-soft landing?
Semi-soft landing. But I do want to point out, too, I mean, Bill Ackman is actually tweeting now because, I mean, what else do you have to do today? But I think it's interesting because he's actually calling into question that 2% target, the idea that, at least in his word, that is no longer credible. Those are his words, and actually basically says that accepting 3% plus inflation is probably a better strategy for a stronger economy.
Remain 3-ish.
3-ish.
Well, how do you cross that when we stick to this 2% inflation rate, but we also have many conversations here on Bloomberg that talk about the changes that are going on in the global economy. We talk about it incessantly, right? We talk about supply chains. They are changing. Globalization pushback, higher energy prices as we shift to alt energy. These are things that are impacting the cost structure.
Right, and that's exactly what Ackman is tweeting. He mentions a lot of, I don't know if you're reading his tweet or you just came up with that.
I'm
off
actually
the top of your
focusing
head.
on our show.
But deglobalization, he mentions that. He talks about the transition to alternative energy. So you were just reading this tweet.
No,
anyway,
I wasn't. No, but how many conversations do we have about this, right?
You're right. You're absolutely right. You're right, and he's. I think he's right in this as well. And for that matter, I think Powell has actually addressed this in the past. He didn't address it today, but he's addressed this in the past, that there are structural issues out here that really is kind of outside the purview of monetary policy.
That's actually one of the most interesting takeaways that I had from his press conference was his comments again about the labor market. And he stopped short of telling lawmakers what to do, but he really did tell lawmakers what to do. He said he hears from executives, if you're a CEO right now, you cannot find labor. And he talked about, there being several reasons, including people dropping out of the workforce, people dying from COVID, but also migration has come down so much. He's pretty much sending a loud and clear signal to policymakers that we need to increase in migration in order to get more people to fill these jobs.
It's about bringing immigrants in to help out with the labor market. It's about bringing immigrants in to help out with the labor market. I don't know. I feel like this is a bit sticky.
Yeah, although that word forever worries me because we thought we solved inflation forever too, and we didn't.
That's true.
Did we? Who was that? Who was we?
A couple years ago, everyone was like, "Oh, there's no
editorial week."
I certainly went. Yes, the halcyon days when everything was transitory. Just real quickly, guys, not to get us too off topic here, but crossing the wire, Warner Brothers Discovery actually making an announcement about the restructuring charges that it needs, $4.1 to $5.3 billion in pre-tax charges here for that restructuring that, of course, they've telegraphed for quite some time. But that's also something I think to keep an eye on going forward here, because it's not just about the health of the consumer. There are a lot of businesses out there that also have to sort of rejigger their companies in a way that I think is going to sap a lot of activity out of the economy.
In a higher rate environment, Warner Brothers shares are down about 1.4% now in the after hours. All right, guys, that's a wrap. I'm out until after Christmas, so
that's it.
Merry Christmas. I'll be back later.
This is your only. Were you here yesterday? Or before? I don't understand your schedule. She works one day a week.
You should get my contract.
I got to get her.
We just decided 2 days a week.
Merry Christmas.
Merry Christmas.
Bye,
Happy
Carol.
holidays. I'll see you guys after Christmas. All right, that's a wrap. We'll see you again. Some of us. Same time, same place tomorrow.
Yeah.
Here for many, many, many reasons, including
we have a certain someone on the list who has really emerged as a dominant figure in sort of the FTX fallout, and that's the new CEO of FTX. But of course, like the beauty of this list is that you have to kind of like rewind the clock and start from the beginning of the year. And I don't think that there's any more dominant theme across this list than Russia's invasion of Ukraine. And again, people emerged from that situation, one being Zelensky, and how could you not talk about Zelensky when you talk about 2022? But there are many, many more, and what Brett Vegan is tasked with on the Business Week team is canvassing the newsroom to help put spotlights on important people, some of which you probably know, and then a lot of people. The special part of this list, like Carol said, is like this little cross-section that happens when you bring together a lot of various people and themes, and there's these gems that sort of emerge that are not household names, and that's what I love. Is like you take a Zelensky and you put him next to Brett. Take your pick. Who's an unheralded name that will surprise people?
Let's see. Someone like Pinky Cole is probably someone that a lot of listeners haven't heard of. So Pinky is the founder of a vegan fast food restaurant chain called, I think I'm allowed to say this on the air, Slutty Vegan. She started the year with 4 restaurants, and by the end of next year, we'll have more than 20. And these food burger chains. And she's just a great story. Basically raised $25 million this year with the help of Danny Moss.
New names over the last few months is like thanks but no thanks, because and there's always a great reason why somebody I spend hours thinking about, and I write you up this little bio, and I get this email back that's a gentle sort of letdown. It's pretty incredible though to see this list and how it comes together. How many people do you think you consider before you're coming up with getting it down to 50?
Well, I just want to say thank you, of course, for your contribution.
I'll try again next year, okay?
We really appreciate it. We are always looking for people next year. So I don't know. I would say that probably we wind up giving about 150 or so people a look. And the thing that really separates those who wind up on the list from those who don't is data. We look for a hard data point. We look for a metric. We look for something that underpins the nomination, something that we can point to and say, in 2022, this is a fact that really deserves recognition and merit. There are a lot of people that we consider who had good years maybe last year or expected to have good years next year, but we don't have that sort of hard metric. And without that, it is really hard to sort of get on a list. But now you know, right? So we know for next year.
Thank you.
Well, and sometimes it's Popeye's chicken sandwich or something that makes the list. You always have something that's not quite human and inanimate.
Inanimate is the word, Carol. Inanimate.
Thank you, Joel Weber.
I actually when I was in the office the other day, I'm noticing now that some of the TVs and computers were using some of these photos as screensavers. So if you can imagine, that's the impact that this has had. So that to me was kind of our no-brainer inanimate object. Although I guess technically it is moving, right? Because it's in space.
But it's not alive. So
it is not alive. That's correct.
Okay, so I think we can't really talk about 2022 without a certain blockbuster that it was actually kind of decades in the making. You want to bring us up to speed on why a certain maverick filmmaker ended up on the list?
Yeah, I mean, this is a great example of, I think, someone who everybody knows. Everybody knows Tom Cruise, and everybody knows the movie Top Gun. What you may not know is that Top Gun Maverick is actually the biggest movie of his career. And if you think back to all of the huge movies he's been in, the Mission Impossibles, Risky Business, the original Top Gun, this is actually #1, and it's the biggest movie all year. And the thing that I think is kind of cool about including someone like Tom Cruise for this is that, this is actually a story about COVID in many ways, a story about the pandemic, because many streaming services attempted to buy this movie during the early days of the pandemic when there weren't a ton of blockbusters coming out, obviously, and people weren't going to theaters. And Tom Cruise, because of his power in Hollywood, basically said, no, I make movies for the big screen, and this is going to be in movie theaters when the time is right.
Who's one to watch? Keep an eye on these people because they could be on next year's Bloomberg 50.
Oh, I love Jimmy O'Brien from John Boy Media. I don't know if you guys ever follow them, but they do these meticulous reconstructions of sports plays that are so fun to watch online.
All right, great stuff as always. Guys, thank you so much. Brett Began, senior editor at Bloomberg Business Week via Zoom in New York City. Joel Weber, he's the editor of Bloomberg Business Week on the Access Line in Brooklyn.
The Bloomberg 50 is featured on the Big Take podcast at Bloomberg.com or wherever you get your podcasts. And do not miss the Big Take on Bloomberg Radio weeknights at 11 p.m. Wall Street time.
This is Bloomberg Business Week. Carol Massar, Tim Stanovic. This is Bloomberg Radio.
markets, headlines, and breaking news.
0.6%. The Dow dropped 0.6%. The Dow dropped 142 points today, down 0.4%. Nasdaq lower by 85, a drop there of 0.8%. The 10-year yield 3.47%, with the 2-year yielding 4.21%. Spot gold down $3 the ounce, down 0.2% to 18.07, while West Texas Intermediate crude oil was down 2.7%, 77.40 a barrel on WTI. Bitcoin did trade above 18,000. Now it's 17,811. Bitcoin up by 0.3%. Recapping, we've got the 10-year yielding 3.47%. S&P 500 index on this Fed Wednesday down 0.6%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
It is indeed. All right, Charlie, thank you so much. Well, earlier this year, as the world began to reopen, Bloomberg Live hosted its first in-person event in New York City since 2020. That was back in March. We were kind of reminded that at a media town hall today. The event was called Work Shifting 2.0, Redefining Normal. And at that event, Tim, you talked with our next guest.
Rob Valzin, Vice Chair at Prudential Financial. We talked about the state of the American workforce, and I remember that one, Carol, because back in March of 2020, when was it? I think it was probably March of 2021.
Yeah.
I did an event with Rob that was virtual. So this was actually the first time I got to meet him in person. And to us, it really represented, a reopening. And look how far we've come since then. This discussion, though, about reopening, it's ongoing, it's debated, it's in terms of how we work post-pandemic. Rob Valzin is Prudential's Vice Chairman, and he joins us once again with an update on the latest Prudential Pulse survey. He joins us via Zoom from...
So understanding what's going through their minds and how they're faring, sort of, we thought was an important set of observations to be able to get. What we found, sort of interestingly, is they're experiencing some pretty notable shifts in their attitudes toward work. Less loyal, more mobile than prior generations, and they're also quite financially insecure, and it's leading to sort of behavior that is also challenging from a risk standpoint as well, and trying to make up some of the ground that they've lost by virtue of sort of when they came into the workforce and the experience that they've had since they've been in the workforce.
So, one of the things we love, Rob, is that you have kind of been a gut check for us in terms of how we think about work and what it means post-pandemic. What are the trends that you think are going to stay with us based on some of the survey results?
Well, it's really clear, Carol, as I've talked about before, we've talked about before, that the most sustained trend going forward is going to be this hybrid work environment. As I've often reflected on before, in 2019, we all knew how to work in the office, and that worked okay. And then in 2020 through earlier this year, we learned how to work remotely. It started pretty rough, but by the end of that period of time, not only did you learn to do it, people learned to enjoy doing it that way. And so the challenge we have going forward is, how do we create an environment, a work environment going? And I was calling out and saying, listen, what we learned is that remote does work. You guys were very productive remotely. Productivity went up. Productivity went up across the country, but productivity in our company went up. We saw it.
I mean, is that because people aren't commuting and they're spending that extra time working? What is it?
Absolutely, Tim. Absolutely.
Okay.
And they're more focused when they're at home. Once they got through that initial period of the distraction of the kids and all that kind of stuff. Once, infrastructure could
I don't know who these people are.
What?
These ones who are more focused when they're at home? I'm like, oh, I guess I got to put the laundry in the dryer. Oh, I guess I got to make myself some lunch.
I'm sure there are absolutely aspects of that, but the reality is there are a lot of distractions in their workplace if you're trying to be at the computer getting things done. And what we saw is that productivity held up despite concerns that we would dramatically lose productivity. Some of it's sustainable because it came about, Tim, because we enhanced technology to enable people to work remotely. That's sustainable. Some of it's by the longer workday. They reinvested their commute plus some in many instances. Not all of that's sustainable, right? People need to regain balance. But the point being, at the end of the day, they increased their productivity. The challenge is that's short-term productivity. What we're concerned about is not only productivity in the short term, but productivity in the long term. We need to ensure that we're having the sort of creativity, ideation, strategic planning that was going to make us competitive and successful in the future. That doesn't happen as well remotely. Learning for junior employees is stifled on a fully remote basis. They learn better in person when they get the benefit of apprenticeships and mentorships and can see and talk to people. And so we got to find the right balance between the two. They're not mutually exclusive. We can get
people you surveyed, the Gen Z and millennials, are making when it comes to their finances. It got me a little concerned about the way that Gen Zers are thinking about their finances and where they are in terms of how stable they are. What are they doing?
So they're not very stable. Less than half have any sort of emergency savings. Listen, we have a lack of emergency savings across the entire population, but it's more acute in the younger generations. It's the bank of mom and dad when it comes to those emergency savings, is what the survey says.
Could you have said the same thing though about millennials, 15 years ago, and then Gen X 25 years ago? I know you didn't do the survey then, but could you have said the same thing?
Yeah, we didn't do those surveys, so you don't know. I'm sure there was some aspect of that. It seems to be more acute now, Tim, okay. that there's because
that's kind of scary, Rob.
They're more vulnerable.
It's a little scary if we think about it.
Yeah, it is scary. And what's more scary is that there's this risky behavior that's occurring that the only way I'm able to rationalize it is it's sort of like it's a gambling phenomenon of when you've got nothing to lose, there's not really risk associated with gambling. They're in such a state of being behind on their own career development because they came out of school either right at or right after the great financial crisis. So they were dislocated in the starts of their careers just as they're getting to what are supposed to be their highest earning years. We hit a recession, we hit a pandemic, where we could be hitting another recession, and so they've been disenfranchised from what has otherwise been a social contract of work hard, go to a good school, get good grades, you'll get a good job, and you'll get financial security. They're like, none of that's happening for us, and so when we're going to try something different. And something different is they're not using traditional funds have been increasing. They've not kept up with inflation. So I think that's a really bad outcome for workers across the country. Carol.
15 seconds. Are you expecting a recession next year?
We have a variety of views on that. It's going to be it's a high wire act for the Fed to avoid one. I'll say that.
All right. Rob, always good to get some time with you. Tim and I both appreciate it. Happy holidays. Be well. Happy New Year. Rob Falzon, he's Vice Chair of Prudential Financial, joining us via Zoom from New Jersey. Some sobering comments, though, right?
Yeah, really are. Let's get to world and national news. Nancy Lyons is in our 99.1 newsroom in Washington, D.C. with an update. Hey there, Nance.
Thanks, Tim. President Biden says America should feel collective guilt for its failure to tackle gun violence as the country marks 10 years since one of its worst ever school shootings at Sandy Hook Elementary. Connecticut Senator Richard Blumenthal says gun reform remains a top priority.
We need Ethan's Law, safe storage, such as we've done in Connecticut, strengthen red flag and emergency risk protection order statute, better background check systems to make them more complete and better enforceable.
Blumenthal says we must honor the lives of those lost to gun violence by reforming gun laws. Victims of the murderer accused of using an assault weapon to kill 5 customers at a gay bar in Colorado Springs are urging lawmakers to act. They spoke today at a hearing of the House Oversight Committee.
The witnesses included the club owner, a bartender, and James Slow, who was shot in the arm.
Club Q was a second home and safe space for all of us. We are continually being dehumanized, marginalized, and targeted. Hate starts with speech. The hateful rhetoric you've heard from elected leaders is the direct cause of the horrific shooting.
Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
I'm Charlie Pellet. To move lower for stocks today, the Dow, the S&P, NASDAQ all finishing in the red. Stocks snapped a two-day rally after Fed Chair Jay Powell reiterated his hawkish stance but signaled the central bank is getting close to reaching the end of a tightening cycle. So what about the next Fed meeting? What about shifting down to 25 basis points?
I haven't made a judgment on what size rate hike to make it. Having moved so quickly and having now so much restraint that's still in the pipeline, we think that the appropriate thing to do now is to move to a slower pace. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financial conditions.
And reaction to today's 50 basis point move from Alan Lance, research director at lanceglobal.com, who was our guest right here on Bloomberg Business Week.
Fed Chair Powell was talking about, being more in restrictive territory, and, even mentioned a 25 basis points on the table for February. So that was, positive, for stocks. Yet, there are also comments on, that inflation is going to be sticky and especially on the wage front.
In the end, it's of 1%. Recapping, 10-year yield 3.47%, S&P down 0.6%. A Fed Wednesday. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
The last Fed meeting in 2022.
We got to wait for February.
The clock is already ticking. All right, Charlie, thank you so much. So earlier, we talked with Brett Began and Jill Weber at Bloomberg Business Week about the Bloomberg 50, the 6th annual look at those in business, politics, science and technology, finance, and entertainment whose accomplishments deserve recognition. Our next guest is on that list.
We're talking about Michelle Eisen, a lead organizer of Starbucks Workers United. She joins us this afternoon via Zoom from Buffalo. Michelle, it's good to have you on the program. How are you?
I'm great. It's great to be here. Thank you so much.
Welcome.
Well, let's talk about what the past year has been like for you and your efforts and the union's efforts, Starbucks Workers United, to get workers at Starbucks across the country unionized. How's it been?
Well, it's been a crazy year. Certainly not every year I anticipated. A little over a year ago, there were 0 unionized Starbucks locations in the United States. And as of today, we're over 270. So it's just been fast and furious and hard, probably the hardest year of my life so far.
So when we talk about 270 locations, first of all, do you expect it to continue? And then how many workers are we talking about, Michelle?
So we're up over 7,000. That encompasses 7,000 new unionized Starbucks workers in just over a year, which is a big number. I mean, when you
union organizers and people who join the union are looking for from the company right now.
I think that you're correct. I think that's what has become so apparently disappointing to me in the last year is that I came to this company back in 2010 because of who they prided themselves to be, because they were this progressive company that, claimed to care about the environment and the community and most of all their workers. And I think that was true when I started. But we've seen a very clear decline in how workers are treated within the company in the last few years. And the pandemic really shined a spotlight on just how they actually feel about us. We were called essential. Starbucks stayed open through the entirety of the pandemic. These are not remote jobs. We have to go in person in customer-facing positions to perform these job duties. And they kept saying, you're essential. You're essential to keep the world running. But we were continually treated like we were disposable. And we'd had enough. It was time to, hold the company accountable. These are billion-dollar corporations. Billions of dollars are made off of the backs of the labor that is in the floor of these cafes every single day. And yet you've got workers who can't pay their rent and put groceries in their fridge. There's an imbalance there and something needs to be done about it.
And Michelle, I'm going to play devil's advocate a little bit here, but I do wonder, publicly held companies, right? They're held to these standards that if they don't meet their numbers, they're going to get beaten down by Wall Street and investors, and potentially that could lead to more job cuts. It's a fair argument. I see it happen, over and over and over again. So is it always going to be problematic that you will have these wide...
Far cry from what we saw, at the peak of labor unions decades ago. But today we are seeing drives at places like Apple, REI, and more. What do you make of that?
Well, I think you're seeing, the wealth gap is significantly higher than it was even at the peak of the labor movement decades ago. So I think that's part of the catalyst. Certainly the pandemic and the fact that the working class was put in a position where their health and their family's health was at risk daily. If you were a service worker, if you were a worker in, one of these shops that continued to stay open and provide what they were calling these essential services, and you had, CEOs on these financial shows boasting not only about profits, but record-breaking profits in the middle of this pandemic. And workers are starting to question what their worth actually is. And there's a realization that, we are the people who bring in these billions of dollars. If the working class just walked out of all of these businesses right now, these businesses would essentially cease to exist. And so I think you're starting to see people stand up and demand, fair wages and at the very least safe working conditions, because these companies don't exist without us.
Michelle, in terms of, in general, the momentum to unionize above and beyond Starbucks, I'm curious if other companies or people at other companies have been reaching out to you more and more about how to kind of unionize at their own places.
They are. Certainly the first to reach out to us.
Congratulations on being part of the Bloomberg 50. She mentioned Chris Smalls, who has also been very active in labor unionization efforts. Check out the Bloomberg 50. This is Bloomberg.
It is 4:53 on Wall Street. I'm Charlie Pellet with today's company headlines. Pfizer clinched an agreement to sell its antiviral medication Paxlovid in China through a state-owned company, making the drug available to battle surging COVID-19 cases. Pfizer shares up today on a down day for the rest of the market. Pfizer up today by 2.7%. Delta Airlines has boosted its fourth quarter earnings outlook but trimmed the top end of a revenue forecast, keeping a bullish travel forecast even as smaller carriers see weakening demand. Both Delta and United Airlines do expect continued expansion despite the risk of recession next year. Today, Delta was up by 2.8%, UAL down 2.6%. Bank of New York Mellon is going here. That is $1 billion more than analysts had estimated. Again, Charter Communication shares down 16%. Those are the company stories we're following this hour. I'm Charlie Pellet. This is Bloomberg.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
It's Bloomberg Business Week. Let's get an update on world and national news. For that, we turn to Nancy Lyons, who's in our 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. 10 years after the Sandy Hook Elementary School shootings, one of the worst school shootings in U.S. history, residents of the Connecticut town where it took place have been marking today's anniversary by attending vigils, paying their respects at a new memorial, and reflecting in private with their loved ones. In Washington, Connecticut Senator Chris Murphy remembered the victims and survivors from the Senate floor.
My sorrow today is for what we lost 10 years ago today, for the genius and the talent that was extinguished from this earth, those kids and those educators.
Murphy's colleague from Connecticut, Senator Richard Blumenthal, says universal gun reform is needed. A long list of companies made pledges to stop giving money to lawmakers who voted against President Biden's election victory after the January 6th attack of the Capitol. But as Bloomberg's Nathan Hager reports, those pledges did not last long.
Bloomberg News has reviewed hundreds of campaign finance disclosures from March of 2021 to this past month. They show companies like AT&T, Amazon, and Intel quietly reopened the campaign finance taps in time for Republicans to win back control of the House of Representatives.
In more than 120 countries. I'm Nancy Lyons. Back to you, Carol and Tim.
All right, Nance, thank you so much. All right, now let's check in with Joe Matthew. He's host of Sound On Bloomberg Radio. That's coming up in just a few minutes. Joe Matthew, all about the Fed today.
Well, that's the big stuff indeed, and we're always lucky to have Michael McKee with us down here in Washington. Every now and then we steal him from you, and that's typically you're on a Fed meeting. So we're going to go to school with Professor McKee, and then take the deep dive with Mark Zandi. It's interesting. Do you believe? Are you guys buying the bullish, or do you think this is an act?
What do you mean, bullish?
Well, the hawkish routine from Jay Powell today, or is he going to pull that back when the next CPI is weaker than expected?
He said he was impressed by the last couple of dovish inflation prints. He says, I welcome that news, but he reminds us that we've got a long ways to go to get down to that 2% target, which he continues to stick to.
We have a long way to go, and there's a big political side to this. This is not exactly what the Biden administration wants to be hearing just a day after the president said, we should be fine by the end of next year. So we'll have that coming up with Mark Zandi. We're going to take another look at this second day of hearings, by the way, on FTX. It went to the Senate side today. Some absolutely fascinating testimony that we'll bring in on coming up this next hour.
I'm glad there's nothing going on, Joe.
Never, ever.
Hey, Joe, can you do me a favor and ask Mark Zandi about consumers' cash balances?
Absolutely. What do you want to know?
I just want to know how they're doing right now. I mean, Moody's has some great data on how much consumers have saved up. And what we hear over and over again from folks on our show is concerns about a mild recession in 23.
Have we spent our COVID savings? Is it finally gone?
That's the question.